Everyone, and welcome again to the Money Game with AC. So the market is now in what we call a bear territory or recession territory. Literally what it means in simple language is the Dow Jones and the major indexes, S&P 500, the Nasdaq, are now down to a minimum of 20% since the beginning of this year. All right. So it means that we are testing again the levels that we touched around June, when initially inflation wasn't going down as soon and as quick as we thought it would go down. And since then, it's been nothing but fear, uncertainty, and doubt, and a lot of negativity in the market, just because everybody is trying to figure out what will be, the future. How will the future look like when it comes to economy and inflation, and would we have a deep recession or even a depression? So I'm going to share with you in this video, what I'm seeing, what is happening in the market, how you can take advantage of it as an investor, and how you should actually, prepare yourself when it comes to the next 3 to 6 months, because I think there might be some good news outside of this whole Red Sea we're having since, pretty much 2 weeks time now. The market, as I mentioned earlier, are not getting any type of rest when it comes to, the red. Everything is just red. Even today, when the market opened, everything was just, given the impression that we can go back to a green day, but no, we didn't have a green day because we had a reversal, and everything is, happening because of this. The rates are what we call the bond yield. It's pretty much what you will get if you invested your money into a bond for the next 10 years, which we call also treasuries. All right. So it's now flirting with the 4%. And anytime rates increase is because people are kind of taking money off, the stocks, the equities, and they are putting into the bonds, putting into those papers that will give you an interest rate. And the higher this yield goes, it means that a lot more people are flocking money into bonds because they don't know exactly how stocks will pertain. On top of this, you also have the dollar. The dollar is gaining and gaining and gaining, and has been gaining, especially since the Federal Reserve has been increasing interest rates. The US Central Bank is the only central bank in the world who had so far multiple interest hikes. London, the EU, Japan, China, Brazil, all of the other, big central banks did not go as far as the Fed. And that's why the dollar is so strong, because there is so many demand into treasuries, US treasuries, making the dollar as a currency to go a lot more higher. I mean, things happening in Ukraine and Europe, in Russia, is not helping as much the dollar, but it is what it is. And when the dollar is high, as it is right now, it's very, 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 difficult. It's very, very hard for businesses to continue to make and do business because of, high currencies. High currencies means, shipping is going to be a lot more expensive, buying your input, your goods, and even for services is going to be a lot more expensive. All right. So it has its good, its bad, but initially see that as a sign that people are already thinking that we're going to be in an economy slowing a lot more than anticipated. And that's why the market is kind of like, I don't know, man. I don't know. Now, in the midst of all these things, the Fed is really at the origin of everything, because the Fed said we're going to do whatever we need to do to bring inflation down. And, one of the governor, Karashi, said that again, I think yesterday, and that's what caused another sell-off, as we saw on yesterday's trading session. Fed officials are in a rare unanimity on bringing inflation back down to 2% target. Kashkari said. Kashkari. So that was September 27. Now the thing is, so today actually, for the inflation to come back down to 2%, it means that there will be a lot of work to be done. From where we're sitting now, to 2%, that is a lot. It means that maybe for the next entire year, the Fed is going to increase interest rates every month, or maybe every other month. So it's mind-blowing to people, because it means that the housing market, the job market, is going to go significantly down because of interest rates increasing. Now, some people think that this might be a big mistake, and these are, smart mind, inflation people on Wall Street. The Federal Reserve is missing a crucial turning point in its fight against inflation because it believes in flawed data. I mean, I share this with you sometimes that the CPI data is not one of the most well calculated in terms of making sure all the real time factors pricing and inflation are properly figured out, properly calculated. And that is a good point because not only they are lagging, but also it doesn't take into account, for example, the decrease in prices that we've been seeing for the last 6 months coming from the housing market. We're not seeing that. Something for the rents, we're not seeing that. So actually in real-time data, inflation may have already started to peak and go back down, even though the latest numbers are showing a different total story because they are not only they're lagging, but they are not really properly calculated. So that's number one. And then you also have people like Kathy Woods who said that the U.S. economy will be gripping with deflation. This is the opposite of inflation, in the next 6 months, and the Fed could be forced to pivot in the face of demand destruction because demand destruction already started. We already see some of the, consumer spending shrinking and shrinking. We already saw some of the, other part of the economy also slowing down significantly because people stop just buying stuff, which was not the case, just 1 or 2 years ago. And because of that, it means that they don't need to go and continuously be aggressive because those future rates won't be necessary because what is actually already happening is what they are looking to happen. So no need to go further because if they do, then something can break and cause the entire global economy to go into a depression, which is what we saw kind of around 2008. And that could lead the central bank to pivoting from its rate hike policy soon, which will really literally means that we are turning around. So I do believe that people from the Fed are smart enough to listen to other bright minds in Wall Street, such as Kathy Wood and also Jeremy Siegel, who is Wharton professor, and he said that, honestly, I think Chairman Powell should offer the American people an apology for such poor monetary policy that he has pursued and the Fed has pursued over the past few years because they were saying inflation is going to be transitory, but it ended up not being transitory. And as a result, they now have to kind of catch up, and by overdoing, they might break something. So it kind of joins what Kathy Wood and this other opinion on Market Watch are saying. Now, if you add to that now what we call technical analysis by looking at the fear index, the VIX, which literally gives you an indication on how sold off the market are, how people are selling in the market. And usually if you look at the high it touched in the last 6 months, we are pretty much there. It touched, I think, 34. The highest during the year, 50-week all time, is around 39. But if you look last time in May and in June, when the market hit the bottom, it was around 34. Today, it reached 34. Today, it did reach 34. So I think we are almost there when stocks are now trying to hit that bottom where everything is pretty much discounted, and the big whales, the big boys with the big pockets will just come in and start buying everything because everything is so cheap now that it will have a rebound. So I do believe we might have something happening here as a reversal. Stocks can start having more green days. Maybe not, maybe not next week, but definitely as we know the coming weeks, as we are now getting a lot more indicators that things may not be as worst as we thought when it comes to inflation till we get to the end of this year. Now, as an investor, what does it mean? Well, if you're an investor and you're looking long term, I don't think it would change anything for you because your horizon is long term. This is just an opportunity for you to add a lot more to your long term position. So what I'm doing is continuing to buy my favorite ETFs, my favorite stocks and mutual funds, and potentially some cryptos because everything is just on discount right now, but it won't stay that way. So it's a very good time to start building wealth. And if you stay a little bit patient, then when we come to the other side of it, maybe by 2023 or 2024, you will just wish, why didn't I add some more? Why didn't I buy some more? Because we'll then enter the next bull run.